Hi, everyone, and welcome to the weekly update. It's looking a lot more positive this week, the markets, as I'm going to show you. And I've got a record 116 slides, so there's a heck of a lot to get through. What I would suggest you do, therefore, is have a phone in hand with which you can take pictures of some of the images. Let's get on with it straight away. Oh, by the way, let me know you can see and hear me. You've already started, haven't you? Antrim, Cardiff, Swansea, Auckland, New Zealand. Peter, welcome as well. Little Bookham, Glasgow, Aberdeen. Lots from beautiful, gorgeous Scotland. And the fairest maidens of the land are from Scotland. Now, let's look at the slides that I've prepared to take you through everything on this fine sunny day. Here we go. And thank you for being on the webinar. You're the winners because you're the ones who, despite the sunshine. Now, I'm going to make sure it's quick and to the point because you'll probably want to get back into the sun as well. Okay. Portugal, Ireland, sunny, lovely, gorgeous Scotland. Welcome one and all. Let me know also if it is your first time here. I've got some files that I want to share with you all as well. So we're going to have quite a few interesting things on this webinar, things that I've not done before come up. So you've really chosen the best one to be on. God knows when that book's going to come out. Remember, this is not individual investment advice because I don't know you personally, so I can't do that. What we're going to cover in all of this, just as a reminder, we're going to look at, well, what I keep calling the bellwether stocks. If somebody said to me, surely they're the leading companies. I just thought they were the ones which set the sentiment for the market. So I am actually going to go through the sentiment changing ones. First thing that I want to share with you, somebody asked me earlier today, they said, look, is there a good month in which to buy? Sometimes they ask me, is there a good day? I'd probably say avoid Friday afternoons because you never know who's going to bomb who over the weekend. But in terms of a good month, don't read too much into all of this. You know, the whole sell in May and go away till, November the 1st. Anyway, I just thought I'd share that data. Like I said, don't over analyze that. Will said, you're many things, quick and brief and not amongst them. I apologize. You're probably right. Even my cousin laughs at me and says exactly the same. Now, Microsoft. Just to give you an idea of valuations, red means overvalued on conventional measures of you're paying $30 for every future expected dollar of profits. Why would you pay 30 for Microsoft and only 11 for ExxonMobil? I'm going to show you Exxon's chart in a second. Well, because of growth and because value isn't the only factor to examine. What are the factors to examine? I will share those with you in this video. For instance, the many things that we're going to be looking at in this, and none of these meet my criteria, by the way, because they're not green across the first 5 columns of value, growth, income, cash, return on capital invested, momentum, and so on. But value is not the only factor. It is one of the most important. If I had to put a weighting to it, based on the academic literature, it's about 40% weight when you're considering making a decision on a stock, but it's not the only one. These are some of the companies we're going to examine today, everything from S&P, NASDAQ, Microsoft, and so on. And it's looking more positive than it was a week ago or even 2 weeks ago. Positive, yet there's sort of a limit to how much further we can go, I feel. There is a cap. There is some headwinds due, but positive in the near term. And I'll get specific numbers to you in just a second. Like I said, these are all the factors that I want to look at: value, growth, income, cash flow. My job is to throw out the bathwater, and if a few babies go with it, I don't care, as long as what's left in the bath are babies and as little dirty bathwater as possible. I am not trying to separate bathwater and babies. There's two different things, and people don't understand that. I don't care how many good companies I don't invest in, as long as the ones I'm left with do my pension proud. That's all that matters. Okay. And that's what confuses people, because they think their job is to be more perfect and know what's going to win and what's going to lose. If you try and do that, you're probably trying to be an academic or a rocket scientist. So avoid that. Over the past week, it's been pretty much green across the board. NVIDIA, regret getting out too soon. Microsoft, do I regret getting out too soon? Well, no, there's nothing stopping me getting back in. But remember what I said, I'd held them since January 2023. In the case of Microsoft, 2 times leverage in my son's junior ISA. So each time it dropped 1%, he'd be losing tens of thousands, because in a junior ISA there's a limit to how much cash you can put in. So I did 2 times leverage exchange traded funds in those. But I got Amazon still. I've still got Apple, half of Apple. Alphabet, Meta, do I regret getting out too soon? Well, we'll come to those in a second. But again, the point I'm trying to make to you is my risk appetite and yours will vary. And that's how it should be. We're not trying to pick the precise top and bottom. What we're trying to do is pick out what's precisely right for our circumstances. And the endowment effect is important. So I was endowed since January 2023 with stupidly large gains in these, oversized, that even a small downward move meant that I had more to lose than gain going forward. Okay, now it might be different for others. I want people to think independently, and we'll go through this so you can make up your own mind about these and a load of others as well. I don't want them to think, oh, I'll just copy what Alpesh is doing, because as I often joke, you might not have 2 private jets in your back garden. Okay. ETF 1 month performance. There's going to be more videos on exchange traded funds. We're going to expand out our coverage of exchange traded funds, actually. And the reason for that is that we're going to increase the volatility threshold, so more get through, so that you've got more to choose from. I'm just going to show something on screen. Here we go. Okay. I'm just going to show something on screen. We go through 6,000 exchange traded funds, looking at their 1 month, 3 month, 6 month performance and volatility. And normally we want volatility to be below that of Microsoft. Microsoft is the safest company I can think of. We're going to increase that to volatility under 20%. Okay. Sortino and Alpha, I want to be green. Now, the reason for that is I want more to appear in my filtered tab, because when I went through the top 100 performers, best performers over the last 6 months, only 3 were not overbought, in my opinion. So I want more to choose from. Now, you might not be interested anyway in exchange traded funds, in which case it doesn't matter. Did you know you can actually get gold covered call exchange traded funds? It's incredible what you can get up there. We'll work out, well, I'll go into what some of the attractive looking ones are a little bit later on. By the way, Goldman Sachs even make funds on Bloomberg indices on clean energy, for instance. There's Japan, emerging markets. You can get one on absolutely bloody anything. So I thought, well, actually, let's have a look at more of those later on. Anyway, these are the performances over the past month of most exchange funds. You can see any of the crypto ones have been absolutely whacked. China continues strong. We'll come to 1 or 2 Chinese stocks later on in this presentation as well. How have the markets fared over the last 12 months? Well, you can see there. Thank you, Will. Derek from Buckinghamshire. Thank you, Derek. Good to be getting out. Stay level. Absolutely. Thank you all. So NASDAQ still up 36% over the last 12 months. You know, people talk about missing boats. Even if you started in May of last year, you would have had a 36% rise. Now, that's not going to happen every year. Let's be absolutely clear. The good years like last year, like 2021, they pay for the bad years like 2022, where your job is, for most of the year, I'm afraid, no matter how excited you are to dive into the markets, to stand aside and just watch the markets drop. Okay, that was the job in 2022. It wasn't to try and find something which doesn't drop, because when the markets fall, most things are correlated downside within the equity markets globally. You might say, well, what about inverse exchange traded funds? What about diversification through commodities and gold? Well, that's a separate asset group, I would put. Okay, so I'm not talking about that. I'm talking about stocks or cash, because you could equally say, well, what about in those periods, Alpesh buying raw uranium? Fine. Or property. Well, that's a different conversation. I'm just about stocks or cash, okay? So those are the good years, and that's what this year looks not too bad. I mean, you know, there were times last year it looked awful. S&P is up 25% in the last 12 months alone. We'll talk about the future in a second. The Dow up 15 and the UK up 9. Year to date, the S&P is up 8. The UK, unusual for it to be anywhere other than the bottom out of those, and it will fall to the bottom of those 4. by the end of this year. NASDAQ is up 7 and the Dow's up 3. Now, where are we in terms of what's winning the race? It still is communications, energy, and we're going to come to some energy companies in a second, utilities, financials, industrials. Hang on, Alpesh, everyone talks about tech. Well, tech isn't actually the driver. And I don't gamble on sectors. You can either go what's called top down, pick the right sector and then the individual stocks. But as you know me, and unless this is your first time, then what will actually what can actually happen is that you get the right sector. So what? It's companies that I care about, and very much a Warren Buffett approach of I don't care what the company does. If it's making money and the price goes up, I don't care if they make cookies or sweets. He was famously an investor, still is, I think, in Wrigley's and in Coca-Cola. Well, definitely he still is in Coca-Cola. And I can show you his and Bill Gates' portfolios later if you want on the program as well. Oh, let's go to this poll. FTSE, will it be high by the end of the year? 55% say yes. And the rest of you say not sure. Okay, let's do the Dow. I'll also do another fun poll, which is, will Donald Trump be president from prison? And there we go. What about factors? Well, the factors which are winning, and I don't gamble on the right factors. This is a mistake a lot of private investors make. They think they've got to gamble, and fund managers make this mistake, gamble on a particular factor like growth or momentum or value or small cap. Now, the thing is, fund management companies like Vanguard, they raise billions, hundreds of billions through networks and advertising, and then they'll create a large cap value fund, a mid cap value, a small cap value, a large cap growth, a mid cap growth. They'll create a fund for each of these, and then through the IFA networks, they will sell you one of each of these. They'll say, well, look, Alpesh, you never know which one's going to win. Look what happens. So let's diversify and buy one of all of them. And of course, what happens is by buying all of them, you've increased your costs, you spread yourself far and wide. You've certainly not used any of their expertise, because if they had any, why wouldn't they just tell you what's going to do well? Surely that's the point of expertise. No, their expertise is to say, we've got no bloody idea. Let's just help you buy something of everything. Well, that's pretty bloody useless, and they charge you a fee for that. So what ends up happening is they spray and pray, and you get mediocre performance, which is what happens in most pensions. What we're trying to say is, well, hang on. Why don't we just look for companies which tick the value box, the growth box, the income box, i.e. tick all the boxes, and then have 20 in our portfolio? Because that will give us a limited downside risk. If one of them, if we put equal money into each, we've only got 5% in each. If one of them drops, even 25%, we'll only have lost 1.25% of our overall portfolio value as a result. Great. Alpesh, why wouldn't you put it all into just NVIDIA? Well, because if I had a time machine, I would. We did have NVIDIA in January 2023. However, I didn't know it was going to go up 700% since then. Otherwise, I would have bought all of it in just that, as I keep saying people. That's why we don't just buy one stock. And that's why even Warren Buffett doesn't, because he doesn't know what will happen in the future. What are the top S&P 500 stocks? We're going to go through each of these, something different for this month. We're going to go through each of these. By the way, interestingly, a fewer of you think the Dow will be up from today's levels than the UK. Fair enough. Okay, so that's the end of that poll. I'm sharing that with you. 50% of you think the Dow will be up by the end of the year. I'm going to share with you later on a copy of the book Investing Unplugged. So you don't even have to go to the website to get it. So do remind me later on to it'll come through your web thingamajiggy there in a second. Okay. Now, let's go on to each one of these. So this is what's different. I'm going to go through each of these. So this is United Airlines. What I'm doing this week to give you a market update is to give you a market update by saying, well, these are the top 10 S&P 500 stocks. This is their price movements over the past 1 month. How do they look? What do they look like? Well, United Airlines, would I get into it? I know the banks like it. My major concern with United Airlines is, and I'm going to draw this, is when I look at value, growth, income, all my factors, it doesn't tick enough boxes. and that's just going sideways still. So I'd probably want to see it rise a bit more. And my overall concern is it does tend to be quite volatile and go sideways. So not one for me, I'm afraid. I don't have to buy it. And my rule is, if in doubt, leave it out. Okay, so let's look at Howmet Aerospace. Now, this does tick enough of my boxes. I don't care that the analysts all love it. Well, wait a minute, Alpesh, a lot smoother than United Airlines. Probably, funnily enough, rockets are smoother than a United Airline flights as well, I expect. They used to call it United Scareways, didn't they, or Scarelines? My only concern with this, major concern with this, is the monthly MACD is a bit overbought. Now, that doesn't mean it can't keep rising, because NVIDIA kept going up and up and up. All I would say to you is, when it's the highest it's been for the past 6-7 years, 4 times out of 5, the price doesn't have much further to go up. Okay? 1 time out of 5, it does an NVIDIA and keeps rocketing. It's up to you. For me, I'm afraid it's a bit overbought, and I'd rather pick something which isn't as overbought in my pension, but it ticks a lot of my boxes in terms of value, growth, income, and the rest of it as well. There we go. Moderna. Now, Moderna is one which for ages it's been promising to move up. It is oversold. And right now, holding it, I think I still hold it. I'd continue holding it. It's been giving us a few gains, not as many as I expect. But if I didn't already own it, there's others I'd pick today. Okay. But given that I do hold it, I'd continue holding it. No issues. Tyler Technologies ticks a lot of my boxes. Okay. I don't care that the analysts love it, or they all do. And its gradient momentum is good, value, growth, income, ticks enough boxes for me. So I'm just sharing with you, it's only in a different way when I do the market update. Biotechne Corporation ticks a lot of my boxes. Gradient's a bit slow up there. Now, this is obviously riskier. Look what happened there. You may well say, bloody hell, no thanks, mate. Equally, you might say, well, I could do one of these. What you got to remember with any of these is just look at that drawdown depth and duration to break even. Okay, so you might say, no, I don't like that volatility. Not for me. Thank you very much. Garmin, it's one which I think I mentioned a while back, ages ago, and it is coming along strong. Unbelievably, maybe people are going to the gym, or I don't know, whatever they're using Garmin for. They have those watches, don't they? And that'd be the angle one would be looking at. It meets some of my criteria, value, growth, income. So it ticks enough boxes there as well. Just showing you what in the S&P 500 has been driving it this past week, or some of the stocks which have been the best performers. ResMed, nice. Okay. And again, ticks enough of my value, growth, income boxes. All I would say to you is, in an upward trend, this is a volatile company. Look at those drops. Those are the type where, Alpesh, what's happened? It's gone down. And then it goes back up again. Oh, it's gone down again. And then it goes back up again. It's one of those. And you may well want to stay clear of such rides. What I always say to people, and they don't pay heed to this, is look at previous periods where it went up and look at its drawdown depth and duration. If you don't like those rides, move on to another stock. Don't try and change your personality into suddenly somebody. Yeah, it's like me riding a Harley Davidson. I'm not going to be able to be that guy. Don't try and be somebody else. Just find what's suitable for you. Okay, instead. Carrier Global Corporation, also one of the big movers in the past month, meets a lot of our criteria, but my worry is overbought on the momentum. And most times, 4 times out of 5, that then does something like this and falls off. 1 times out of 5, it just keeps rocketing up. Okay. And so for me, if in doubt, leave it out. If in doubt, leave it out. Okay. FMC Corporation, again, one of the S&P 500 biggest movers of the past month. So I want to sort of give you what's been happening. And what do we have here? Well, probably a bit early, a little bit more risky to get in this soon, because whilst the monthly momentum isn't falling, and it is oversold. All those things are good. The problem with this is it doesn't tick enough of our boxes on value, growth, income, cash flow. So whilst it may well do that, bit too risky for me because it doesn't give me enough assurance on valuation. It's not undervalued enough. It's not growing fast enough. It's not got enough dividend yields. That's not to say it won't go up. It's just to say, sorry, doesn't tick enough of my boxes. You can't get into my university. Palo Alto Networks, run by my friend Nikesh Arora, who's their CEO. He used to be number 4 at Google. Okay. 50-50 toss-up. I know there's been this massive upward general trend. However, they've prolonged periods of sideways. If I'm looking at stocks, which I'm generally looking at holding for 12 months, my problem with this is it's mixed signals. In the short term, yep, should continue doing well. But that's overbought. That could continue falling. So not one for me. But I'm not saying it won't necessarily go up. It's just too many question marks. And I have to be, what I'm trying to get across to you is I'm really, really picky what gets into my portfolio. I am not a speculator. I'm not a gambler. I'm not it'll do, it's close enough kind of guy. Because when you have to live through it and you see it do that, then these lovely little pictures of 30 years don't feel like they're going to go like this anymore. It feels like you're banging your toes with a hammer instead. So sorry, overbought, not one for me. Not to say it's not a great company. It is. Not to say in future it won't shoot through the roof. It will. Not to say it won't go up in 12 months. Probably will. What I'm saying is the ride looks too bumpy for my liking. I'm probably as bloody-minded as a Warren Buffett is, and he sort of uses similar language, which is, yeah, I'm sure it's a wonderful company. It's just not one right for my portfolio. Okay, top 10 FTSE 350s. The best movers over the past month are these. I won't go through, obviously, all of these. Interesting, AJ Bell, the brokers are up there. Obviously, a lot of people giving them money, and plus 500 post-ISA season, I guess, is the thought. It's been a good ISA season for them. Nancy Pelosi has a big position in Palo Alto. Well, so they should say. Maybe she does, maybe she doesn't. How do you know it's overbought? If the momentum's at the top end, that's overbought. If it's at the bottom end, it's oversold. What this graph is showing is short-term average prices that it's had and long-term. If short and long-term averages are both relatively low and moving higher, it's a good thing. If they're both relatively high and moving lower, it's usually a bad sign for momentum. It's not guaranteed by any means. Where are we on the S&P? Well, that's quite nice again. It's still rising, and it looks like this fall, which I thought was going to be more like this fall here, last a few months, and not like this fall, which would last a whole year, is probably going to be closer to one of these here. Okay, and as I've said previously, it looks like the best case is back on the cards again, which is another 18% to the upside on the S&P. It's looking positive again. Now, I can give you some macroeconomics behind that if you wish. I could make arguments about interest rates, budget deficits, change of government. Under Trump, there'll be this, that, and the other. Could make up all sorts of stuff. I'm just telling you what looks like to be the case on the momentum, and this momentum looks very similar to what we had before. It's not to say you can't have these drawdowns. You can, but overall, most times when you've got a portfolio and you're holding for 12 months, each week you might look at this, but there's nothing for you to do. You're not trading. If you're trading, go and trade. If you've got a trading itch, go and trade. Open a spread betting account, scratch that itch. Go to Vegas, scratch that itch. But as I say, even here, most of the times you had nothing to do other than maybe take a few profits from existing positions and not open new ones. Now, at the moment, I've taken some profits, which I'll come to, from existing positions and not open new ones. But I might now start looking at my May list of stocks and seeing, well, do I buy JD.com after all, or not, for instance? And we'll come to other stock names. None of these meet my criteria. Of the few that do this month, maybe I do top up the pension after all. Things are looking a bit better. The FTSE continues higher, like I said. And now, of course, it's picking up. The gradient on the momentum is picking up some traction. Okay. And when it's moving that steeply, well, you can see what the prices have done in the past. Just be warned, there are prolonged periods of sideways moves, and there have also been periods where it's just let you down. It's gone up and looked like it's going to go through the roof and then collapsed. It is undervalued compared to the US. It's well known amongst institutional money that it's undervalued and that there could be some upside to be had. Right. NASDAQ, well, during those upward periods that it's had here, all I draw your attention to, which I've done time and time again, it can have multiple months of drawdowns. That's the depth and that's the duration before it gets back to where it was. So I don't want people thinking, Alpesh, it's been a month. How come it didn't go up this month? Well, because when it's rising, like here, in an upward trend, it can have drawdown depths and duration. And what I'd say to people is, whether it's a stock or an index they're buying, have a think about what its worst case has been in an upward move before and say, are you happy with that? That way your expectations are better managed and nothing comes as a surprise. Or you could put less money into each stock. In other words, you'd have more stocks. With an index, this has 100 stocks in it. You could track the index, or you could, if you were really risk loving, do 3 times leverage on NASDAQ. I'm not saying you would do that today, but for those who are risk loving, if it goes up another 10%, then you make 30% on your 3 times leverage. Similarly with the S&P 500. And am I that risk loving? It's one of those investments which where, okay, if it goes up another 15%, I'd make 45% on that. But if it drops 15 or 10, I'd lose 3 times that. So when I took off Microsoft, I also took off the S&P triple leverage. And I also took off the NASDAQ because there was just, as you can see, a shed load of exposure to the markets. And I thought, let's get rid of some of that and bank some of that instead. Okay, but now it looks like, well, I could have waited, should have waited. Doesn't matter. I'm not trying to time the tops and bottoms, just trying to make enough money. Now, Costco. So I'm going to look at some of these well-known names. I'm going to use the term bellwether, leading stocks which are well-known. Now, a bit overbought here, so that concerns me. Lovely. In the past, it's been a great one, and we've even done 2 times leverage in that in the past, I think in 2021. It's overbought at the moment, again, because it's at the top end, the momentum, and the danger is just as it can rise, as it has done before, drops sharply and then takes a couple of years off. So I'm not saying it can't do this, but I fear that there's more downside risk than there is upside just at the moment. Might be wrong, but I'm not trying to pick every single one, which one's going to be right, which one's going to be wrong. I'm just saying if there's enough question marks, I'll leave it. AbbVie, yeah, if the monthly is falling and that's falling, then not one for me. It's well known. It is in an upward trend. All these banks like it. Again, too many question marks for me because I don't like buying into stocks where the monthly MACD is falling. Personally, I don't like that, like these periods or these periods here. It's not for me. And of course, all you end up doing if you do that, best case, you end up with 0% over 2 years. Worst case, you end up losing a lot of money. So I might as well move on to something else. I've got a choice of 10,000 after all. Okay, so let's look at others. Salesforce, I've not mentioned for a while. And I think I'd said previously I'd got out of this about a month or so ago anyway. And the worry was very simple. It's overbought. If it's near the top end, then I'm scared. Basically scared. I could leave it until it dropped 25% from the high since I bought it. I could leave it for 12 months, holding period. I can pick any of those. I could leave it until the monthly MACD drops below its moving average. I could leave it until it dropped 25% below the entry, whichever of those factors comes first or whichever one I want to do. But for me, actually, it was none of those. None of those. It was just that it had dropped X%. And I had a massive equity exposure across the board. And I thought, I just want to take some profits. And if it drops X%, 5%, 10%, I sold Y%. That's personal. Okay. There's no rule you should follow on that. Your rule could be 12 months, or if it drops 25% from entry. At the moment, I wouldn't buy it now because it's overbought. right? So I'm trying to educate you and inform you at the same time. I got a hell of a lot more slides to get through. This you'll want to look at why your pension fund manager should be shot. It's on the YouTube channel that I've got. Where have I put it? Do have a look at the YouTube channel. It's really good. Well, that's at 120,000 views, which isn't that great. I've got 7.4 million on TikTok for some of my videos. But you'll see why your pension is performing poorly thanks to fund managers, pension advisors, and it's all on there. That's on alpeshpatel.com/links. Right now, we've got a heck of a lot more to get through. We're not even halfway through the slides, so I'm going to speed it up. Chevron, well, that should be going in that direction. As we saw, some of these energy companies are undervalued, and so it's a better one. I've not checked if it meets my value growth income. I'm just giving you names which have been which are some of the best known ones in the markets. Okay, so I've not checked if this would tick all my boxes on value growth income, but in terms of momentum, looks good. And this is to say to you, it's a market update. This will be good for the market. If everything was falling, it would be bad for the market. Okay. The financials, as I've said before, I own JP Morgan, I don't have Bank of America, are trending higher. That is good for the market. Okay. And they have been for a while. Right. So that's good for them. I don't own this one. Okay. Metro, as you know, I got out of. Walmart, well, overbought. So not for me, not to say it can't continue going, bit overbought, not for me. My worry would be this. Doesn't mean that'll necessarily happen. Certainly the banks don't think so. Could continue even higher. But too many questions for me. I've got very stringent criteria for somebody to get in. Okay, and that's why that one's not for me. More slides to come. We're still not even halfway through it, so I've got to speed it up. Have a look at YouTube, as I said, and you'll see the individual funds. Now, JP Morgan, I continue holding, but I'm worried because it's overbought. And I've got to decide when to get out. Do I get out if it falls X percent, say 10% or 15 or 20? Do I get out when 12 months are up? We're making good money on it, so I'm going to stay in for now, especially since I sold so much of my other holdings, the 2x leverage Microsoft, the underlying Microsoft, half of Apple, Meta, Nvidia. I sold tons, so I've got so much capacity now, I might as well hold on to this one. Do you see the thinking process? It's personal. And also, I err on the side of holding things for 12 months and then going through the Excel again. Okay, going through all of this again. So I'm going to err on holding this one. Tesla, not one I own. We got out of it last October, as you know, because I've been covering it every week. I'm covering it alongside all the other well-known companies that I'm discussing, and not one I'd look to get in at the moment either, because it's just, well, if the monthly is falling and the weekly, if the monthly is falling, I don't want to get in. So end of story for that one. Got more questions. Any thoughts on app before earnings today? Full recommended. I don't know. Oh God, there's so much going on. Stephen, yeah, so let me answer all your questions in a moment. Exxon, United Health Group, you can get the charts on Yahoo Finance for free. I don't use Yahoo Finance. I happen to use TrendSpider, but others use TradingView for free. So TrendSpider costs you $1,000 a year. Don't pay $1,000 a year, obviously. Use Yahoo Finance. Okay. And if you want to learn more about things like this for free, alpeshpatel.com/links. There's free materials on there as well. I'll give you a copy of my book. I'll send it on the file. In fact, I'll do it now. So that, oh shit. Flipping heck. Okay. I have managed. Can you see the files, by the way? There should be a thing for files. I managed to delete. Oh, because I didn't press share. Okay, let me just upload the book. I apologize for this because I've not done it this way before. I'm going to send you the book. I know where the book is, Investing Unplugged. Okay, you're all going to get it through your website in a second. Visa, as you know, I got out of. And again, you might say, well, you got out of it prematurely, Alpesh. Why did you not get out of it later? Whereas you've got out of others. Why not this one? Well, because like I said, sometimes I'm not trading my investment, I'm trying to avoid that. But it was one where I felt that, okay, oops, there we go. And I should be able to share it. Is that the one? It's coming through any second now, I think. Actually, I'm going to delete that and do it again because I think the wrong thing went through. Because it was one of the ones which was overbought. And I should have and could have perhaps waited for it to drop more. Could have waited until 12. I think 12 months were up anyway, was the reason with that one. And then money invested elsewhere. Okay. Procter and Gamble moving up nicely. That's moving up nicely. It's one I like. Yes, I know in upward trends, it can have these downward periods, but I think I can handle that. I'm a big boy. I'm more experienced than most, so that's not a problem. So it is one that I like at the moment, and all of these. And that's good for the broader market. It's a market update. It's good for the broader market because the broader market will be looking at that, and it'll drive the S&P higher. And that's a clue. When we drill down, do you remember that scene in The Big Short with Michael Burry, where he was asked about mortgage defaults, and he said, well, I went through every single one individually. So we'll go through every single company individually as well and look to see, here we go, for God's sake, book, here we go, share. Now, you should somewhere have the book come through on your browser, hopefully. And if it hasn't, alpeshpatel.com/links. Let me know if it's come through as well, okay? The Procter and Gamble. So, yeah, I like this one, actually. And it ticks our boxes on value, growth, income. So it ticks a lot of boxes, and the momentum is looking good. Fine. Johnson & Johnson, not so much. I'd give it a bit more time. It's still falling. I know all of these people like it. But probably not going to go much lower, but I'd rather wait a bit longer before considering that again. Okay. On that one, let's go to NVIDIA. You know what's happened with NVIDIA and what I've said already. It's overbought, and that's why I said to you, if it drops X, sell Y, and that's up to you. If it drops X, sell Y. Would I buy more of it today? Well, it continues ticking all our boxes. It's just that I'm concerned about being overbought. Now, I've got some of my students who say, I know, Alpesh, I don't care. I want in. And of course, it keeps going up, and that's fine. Okay, and I may well end up joining them and buying and breaking my rules and buying at a overbought level, which I tend not to, but just because it's so strategically important in the space it's in. Okay, and if I do something over and above my rules and I'm well aware of it, then that's fine. I mean, I'll give you an example. And you might remember this. I bought Beyond Meat once, and it dropped 90% because it had nothing to do with the program and nothing to do with this. And I said that to everybody. I said, I'm just buying it because I'm a vegan. And it's such a rubbish company that I wish I hadn't bought it. But I bought it on emotional grounds. So if I ever do that, like I might go to Vegas and lose money on the roulette table, and I'll say to people, this isn't the great investments program yet. This is me going to Vegas. So NVIDIA is one of those, which if I do it because it's overbought, it'll be because it's outside of that, and I don't mind rebuying it. But we had it since January of last year. I never did leverage on it. So it's been ridiculously good just for my son and my wife. No, my son and wife didn't have NVIDIA. Only I had it. And I know what you're thinking. Well, you didn't give it to your son and wife. They had 2 times Microsoft. They did all right. Okay. And Amazon, they've still got 2 times leverage. And Alphabet, they've still got 2 times leverage. Nobody's got any Meta left, but we might go back in. We'll see. Berkshire Hathaway, Warren Buffett's. Again, the concern is it's overbought. When it's been overbought in the past like that, it's tended to dump after rising for ages. And so that concerns me somewhat about the company. It's not guaranteed to fall by any means, but if I've got question marks, if in doubt, leave it out. Okay, Eli Lilly, when you look at it like this, it just looks like the perfect stock, doesn't it? And it is indeed overbought. And it's one of those which, well, wait a minute, wasn't it overbought here? That was the highest it had ever been there. You're absolutely right. And yet, Alpesh, it just kept going up. You're absolutely right. And if we had got in earlier, we'd just stay in. If we haven't and we got off the train, then yeah, we may well miss it because it doesn't tick all the boxes. So it's one of those which, like NVIDIA, held on for so long because it never dropped, and so just kept making money in it. And would I do this again? Well, not for me, but others might say, no, I want that strategic holding just as I want it in NVIDIA, which is perfectly fine for them. Okay, Broadcom, similar to others. It came last year for us and we got out because it was one of the was it an AI pick or a special situation? I forget which one. I think it was AI, and we got 83% last year. And the year was up, and we got out. And you might say, well, you got out too prematurely. Yeah, fine. Okay, we took 83%, and then we exited. We perhaps should have held on longer. But we know also what happens when we hold on too long. We give up some of the profits. McDonald's, not for me. That momentum's falling. So thank you, but no thank you. There's a whole bunch there. Good. The books come through. Receive with thanks. Good. Analytics, I think I've told you. Yahoo Finance, but you can use if you so wish. Costco, they've said it, have they? Well, let's see. It's one for them. Like I said, for me, I'm not saying whether something can't go up. That's not what I'm saying. When I say I don't want it, I'm saying too many questions for me, so I don't want it. Now, that's a very subtle difference. My job is easier because I'm just saying what I don't want. Okay? I'm not saying this is going to go down for sure. What I'm saying is I will only select the ones which tick all my boxes. And even then, I can't guarantee it's going to go up, but at least I won't have made any stupid mistakes, right? That's just to say, TikTok, it's now at 334,000 followers. It's going nuts. I already told about YouTube and LinkedIn, alpeshpatel.com/links. Okay. And please have a look at my campaign for 1 million to teach 1 million people how to add an extra 1 million to their portfolios. And let's talk about that now over the course of their lifetimes. Okay. That's 1 trillion, 1 million times 1 million. What I'm trying to do is avoid this problem. And this is common. The underperformance amongst active fund managers. 3/4 of active managed US large cap funds failed to outperform the S&P 500 in the past 3 years. Now, that was all the way in 2011. That hasn't changed. Eugene Fama got a Nobel Prize in economics for showing the mathematics beyond this. And why does that keep happening? It keeps happening because the funds keep trading actively. That's one. That's why we try and avoid to trade. Okay. They will very often be fixated on certain geographies, or if just large cap, that's fine, but they'll trade out of them, or they won't have enough weight in the right one. So what they'll do is they'll have a whole bunch of them, 100 stocks, as opposed to, well, let's just pick the best 20. So they'll have a quality problem. They don't reduce their quality, which you'd think, given that if they're supposed to be good, why don't they do that? And then, of course, you've got these numpties. They've got 900,000 clients. They're a FTSE 100 company. And I want to take every single one of their clients because I've met 2 of their clients ever out of 900,000 who said they were happy with it. Every single other one has always said they're absolutely miserable with how much they get charged and how little transparency is. What I believe in giving clients is very simple. The transparency of data for life, all of this data, so they can choose based on that. But how can you do that without the knowledge? So then what we do is give them the knowledge to say why you want undervalued companies which are growing. Cash return on capital invested, which I'll show you in a second, from Goldman Sachs Wealth Management. Momentum from the hedge fund industry. Sortino, which means average high return versus low risk of missing it. That's just a number based on stock prices. Don't you all want high average returns with low volatility of missing it? Can't guarantee it'll keep repeating itself, but bloody hell, I'd rather tick that box than suddenly say a leopard's about to change its spots. Is it a leopard? Alpha, which just means if the market goes up, it goes up more. If the market falls, it goes up more. Not guaranteed to always continue doing that in the future. The past is not a guarantee, but it is a good guide of the future. We know it's a guide because we can look at correlation numbers. We know it's not a guarantee because we can look at life. This is the problem. Blue Whale. Okay, I picked one in 2022. They dropped 27%. Somebody said to me, aren't funds less volatile than single stocks? And I said, well, bloody funds like that. If they don't give you the transparency of what you're owning, you're screwed. Your pension's underperforming as a result. Of course, if you keep trading because you want your portfolio to go up every day, you're screwed as well, which is why my original rule, when in 2004 I won the competition in the Financial Times, I created a simple algorithm. I said to people, the simple algorithm is this: hold for 12 months, or if it drops 25% from the entry, and don't look at it in between. That's it. Because what I found is the more often people looked at it, the more they traded, and then they jumped off good stocks too early, basically. And they jumped, well, basically that was it. They jumped off good stocks too early. This is just to give you an example of what I see all the time: employer pensions, and they look at it and they get next to no returns. Now, I have a theory about this, that imagine last year when the NASDAQ went up 55% or the S&P went up 25%. Imagine what would happen if your pension went up 55% in a year. You may well bring retirement forward. You may well say, Mr. Employer, thank you very much. Bugger this for a game of drafts. I'm off. So I wonder if they really want you to keep working longer by giving you a poor pension. That is a massive conspiracy theory, and I'm not one for conspiracies. But bloody hell, if it walks like a duck and quacks like a duck, it's almost certainly an elephant. Okay, that lady got 20%. The one who emailed me, she got 20%, okay, from her employer over 10 years. What does that mean? That means she missed just tracking the NASDAQ. Forget anything else. And you might say, well, she wouldn't have ever done that. Fine. Maybe the S&P 500. She would have got 266,000. Instead, she got £24,000 extra on 100. She could have then ended up with 266,000 from her 100. Her 100 becomes 266. Instead, 100 became 124. So let's have a look at what I often show people, which is this. Is 40% realistic? 9 whole conditions have to be met. You know, when people ask me, they say, why did you go to all this trouble of looking at all this data? Well, actually, I did it for myself initially, and then we made it available to the public. The reason is, it's not about like the money saving expert, I can save you £3 a week on your electricity bill. We're talking about massive moves. When there's a headwind from the market, like 2023, and we can be in a position to capture that. So when do you get those? When and how can you capture that? Well, if there's a tailwind, like 2021, 2023, when the S&P was up 25%, NASDAQ was up 55%. If you pick high Sortino stocks, remember those ones with high average returns and very little downside volatility, little drawdown depth or drawdown duration, basically. That means high Sortino. And high alpha. In other words, when the market gives a tailwind, they go really well. If it has a headwind, they tend not to fall as far because, like a Microsoft or somebody, they're pretty strong companies with a shed load of cash they're throwing up. But remember, even in 2022, Berkshire Hathaway went down. You say, wait a minute, Warren Buffett's company went down. Everybody knows he always will make money, and he's brilliant, and he's amazing, and he's got a track record which goes back forever. Why did it fall? That's just how the markets are. They're correlated to the downside. Everything falls when the markets fall. They're not. If you wanted to find diversification, you would presumably have bought Berkshire Hathaway. Surely that man is an outlier and a genius, which he is, and therefore, how come that fell? So my point is that you do want high alpha, but you're not guaranteed everything will rise. So there are times when you need to go into cash. Now, for us, it was very simple. And I've said it a million times in my books, and the book you've all received. I've said it in that. I've said it in a million other places. Very simple. For me, is the monthly MACD falls below its moving average, I do not want to be in. Okay? And I've written about it in my books. Now, I would love to rewrite history and say to you, oh, no, it's just because I'm incredibly clever. And you would turn around and say, no, you're not. You told us in your book that you've just given us. And I looked at it. And you said, if that happens, you don't like to be in. So I can't say anything different to what I've been doing for the last 25 years because I've written the bloody thing. You monitor it once a fortnight. Don't do it more often. Good years make up for bad, like 2022 when we got next to 0%. I think a tiny bit up because of some energy stocks in July. The Russians invading Ukraine, I think, was the reason for it, but it's probably problems in the Middle East, rare though they are. Croaky. Cash return on capital invested, that's the Goldman Sachs number. I'll come to that in a second. That generates about 30% per annum for stocks in that basket. And if you hold for 12 months, then reevaluate. So you're avoiding trading, and you've got an exit rule, which is if it drops 25% from the peak or 25% from entry, to be honest, doesn't matter which of those. Only under those 9 circumstances do you get those amazing years. And that's why when people say to me, well, how did you do last year? In 2023, which might be a year we never repeat ever again. So let me just sit on my laurels on that one. The market was up 25%, I remind them. It wasn't me. And it's US stocks. Whilst we do look at LSE, London Stock Exchange, and European companies and have the data for all of them, the ones that I bought and buy are further filtered list, i.e. the MACD rising, in other words, the quality 5, the 2Ms, the 3As, and special situations. Okay, when the special situations are MACD rising and value growth income at least 7, 8, 9, or 10, right? And it was from January to December. It doesn't include any of the picks during the course of the year or any leverage, which would have, of course, increased the returns. Does not mean any will be held in 2024. Anyway, that was the return. Now, that may well never happen again. may well never happen again, because we may never get another 55% rise in the Nasdaq or 25% in the S&P. But notice this. Notice how there were some really big outliers, and there were some which were negative. Wait a minute, Alpesh, if you've got the same process, value, growth, income, cash flow, Sortino, alpha, all of these things, and this is at the end of the year what you're left with and how they look at the end. By the end, they don't look as good as they did at the start, because obviously you wouldn't buy some at the end of the year that you would have bought at the start, because hopefully their prices have become over-ripened, ready for a fall. So how come with the same process they don't all perform the same? Well, don't ask me, ask Warren Buffett. Why does he not have just one stock then? If they're all going to if the same process of selection leads to the same outcome of performance, you'd only have one stock. There's an X factor. AI comes along, or God knows why Sterling Construction shot through the roof. I'm sure somebody could Google it in 2023. Why did it shoot through the roof? I don't know. Okay, there is an X factor. Donald Trump says something or tweets something. And so that was the process. In the best years, that's what happens. In the worst years, you end up holding cash. That's another thing people don't get. They think that stock selection is like a bank account where you're guaranteed a certain return every single day. They're insane if they think that. Okay? My rule is simply this, is what I explain to my family. Assume you plan to invest over 10 years, and with my help, you make 20% instead of 10. All right. Let's say you have 100K in your 401k or SIP, ISA, whatever, and you plan to add a bit each month because you would add anyway, then you'll have $1 million over 10 years. That's it. You'll have $1 million then over 10 years. Now, why is that important? That's important because if you look at this and you look at what happens if it's 15%, you look at what happens if it's 10%, and you look at what happens if it's 20%, then you'll notice there's big variances. How do you improve those variances? Well, you could either start earlier. You don't have a time machine. We can't go back in time. You could save more. Well, you probably like going out for the occasional dinner and the holiday or two. So saving more is probably not what you ideally want to do. You could wait longer. Great. And hit the grave the day before you retire. Or you improve your performance by a percentage point or two. Of all of those, improving your percentage returns by a point or two is the one most likely to make the best difference and the most reasonable, I believe, and the most likely people are going to do. This journey started with me, 20th anniversary. And this is when it started, 2004. I forgot to think into those terms, 2004. And I've recently been opening up a shed, and we're redoing things in the garden. So I've been opening up some old boxes, and I found the original copies of the newspaper in there, and I'll be posting those on TikTok, more of them, because this is what's been happening for too long. The fund manager of the year, the flavor that the market loves, ends up producing poor performance. In 2004, I hadn't set up the hedge fund. I was just a private investor. I did that as a private investor with private investor tools. Okay, yeah, I had my show on Bloomberg TV. I had my weekly column in the FT. So I had access to more tools than most people. But actually, the tools were exactly the same as what I've got now. Value, growth, income, cash flow, Sortino, Croaky, all of those. That's what it was. And then making sure they're filtered. By the way, to open an account with any broker, not Barclays, could be anybody, because sometimes people don't know how even to manage their own. You open a SIP or an ISA, or whichever country you're in, and you ask the bank or whoever broker you've opened with, whether it's Hargreaves Lansdown, AJ Bell, Barclays, Lloyds, whoever, Free Trade, Interactive, AJ, to transfer your existing to them. And then you can pick what you want, whether it's a Microsoft or anything else. What I would say is, please look at what's in your pension. What has your employer chosen? If they've chosen Scottish Mortgage Investment Trust and lost you 50% because it's a well-known name, they've gone on the philosophy that nobody got sacked picking a well-known name. So they're not liable, but they've just cost you 50%. It's your money. You've worked hard for it. That's the approach I use. And the simple rules are 12 months or drops 25%, either from the peak or from the entry price, depending on what you feel. If you become more risk averse, as I did during the course of the year, you've still got flexibility to do it. You don't have that in a fund. You've got the flexibility because you say, well, I've made shed loads since last January. I've got 2 times leverage Microsoft. I think I will take some money off the table. Thank you very much. Like you do anywhere else, I think I'll bank some, and that's fine. The numbers, these are the numbers. Okay, those are the numbers. Value growth, income, cash flow, sorting alpha. If you're not ticking all those boxes, then don't try and enter the market. I don't know what the halfway house is. If you can't do your own due diligence and you give it to a fund manager who's going to blow your money away anyway, then probably the closest halfway house I can think of is an index tracker. Okay, it's probably the safest in between, which is what Warren Buffett says as well. 12 months, 15 to 40 stocks max, and if they drop 25%, okay, those are the rules. Simple as that. Why 20 stocks to 40? Well, because any more than 40 and you're just bureaucratic nightmare, any less than 20, you've probably got too much stock specific risk. I tend to put equal amounts in each, except if it's one of my quality 5, the 2Ms and the 3As, then it can be up as much as 15%, which is the other thing that happened in January of last year with Microsoft and Apple and Amazon. It was more than 15% in, it was 15% in them. And so it becomes so heavy by the time it was recently when I sold out, it was just getting too much money was in them already. Okay. But I've mentioned Barclays twice. I'm not sponsored by them in any way or shape or form. I've given you this book. Have a look. It is, if I say so myself, rather good. It's not for you to say and buy the others. That one, by the way, has got all my Financial Times columns in it. But that's not why. These are the holdings of, hopefully you can see these, Warren Buffett and Bill Gates. That's not for you to go out and buy them. In the same way, look, I sold something right now. Just because Warren Buffett owns Coca-Cola, his risk reward is different to yours and mine. So you don't just buy it because he owns it, or similarly, Bill Gates has it. Okay. And by the way, if you want to look at what's in Goldman Sachs's portfolios, there you go, between the S&P and the Russell, probably a safe bet. I personally want to do better than that. I want to try and get some of the gains these little babies have been delivering since last January. And I only need a few years where the pension does ridiculously large amounts, because then even if I do mediocre, because the market delivers mediocre returns, then at least I'm compounding on a massive gain that had happened. Okay, that's why capturing years like 2023 are so life-altering. CROCI, cash return on capital invested, I keep mentioning. Okay, that's what it means for those who don't understand. It is the cash that your capital is generating in a company. So if a company buys a machine, pays capital for that machine, and it keeps printing notes, okay, because all companies are factories for making money. The way I look at it is every single one of these companies wants to manage my son's inheritance. So they are factories for making money. Well, I want to see how good a factory it is by making sure all of these first 5 things are ticked green. Why do undervalued companies perform better than overvalued ones? Well, because we looked at the academic research on this. And all of that research is there. Let me just close that a second. Okay. All of that research, were people to look at it, and they rarely ever do. But I wish they did, but it's there. Okay. You can see all of that over there, and we go into it and some of the Nobel Prize winning papers as well. So I want to tick those boxes. Why? Because it gives me peace of mind, nothing else. You might say, well, cash return on capital invested. So what if Goldman Sachs said it produces 30% per annum? Not every year. Look, financial crisis, it didn't. Maybe it's a placebo. Maybe it was coincidence and now it doesn't work. Fine. Placebo, fine. I still need to tick that box because I don't want something to have lost and then gone, oh God, I picked an overvalued speculative company. This is a typical portfolio we're sent in. Okay, and you can just see how many gaps there are and how rotten it looks. And then they usually have too many funds. Each one of those funds will have 50 to 100 stocks in it. So they'll have done too much there. Sometimes they think, oh no, it's okay, I've got bonds. Thanks to Liz Truss, their bond funds tanked as well. And they said, hang on, I've got a bond fund. How can I lose 4% on a flipping bond fund? Okay, and that came as a surprise to them, that bond funds give me negative returns. I thought they were supposed to give me an interest rate return. Nope, afraid not. Okay, scattergun effect. This is an email I got from someone who's with Brewin Dolphin, and that's what the fund managers do. I've done this before, so I'm going to run through it pretty quickly. I always ask permission to talk about it. My ambition is to get 900,000 people using the data, having the know-how, and being having the confidence and the knowledge to then select their portfolio so they've got total transparency. This idea should have occurred to me a hell of a lot sooner. It should have occurred to me when Naomi used to work for me. Naomi left university, worked for me for 2 years, and then joined Newton, and now is at Polar Capital. Whenever she launched a new fund, her SEC filings will say, started her work with me. If I can turn my secretary into a fund manager, let me say that again. University, joined me, 2 years with me, then straight to Newton, from Newton straight to Polar. This is like learning to drive, investing. It's not brain surgery. Anybody can do it. The major problem most people have is they don't know when to let go of a stock. They don't know which ones to select. They don't know why they're buying them. Those are the major problems. They have nobody to talk to about it either. So in a way, this has been a long time coming, from my time at university to writing the books on it, to winning competitions publicly in the Financial Times, and then setting up my own hedge fund for institutional clients, not retail, because retail would necessarily mean a conflict of interest. I would always have to say to you, even in 2022, oh, stick with me, I'll be fine. Because in retail, I can't go into cash. Not allowed. The regulator won't let me. I can only hold 5% in cash. The rest has to be in equities, even if I think equities are going to crash that year. That's retail. And you've got next to no opportunity to hedge, because then that would become a hedge fund, and that can only be open to institutional clients. So for retail clients, it's as if the regulators want you to be screwed. So and by the way, when I'm on TV as well, I'm talking about the same approach. We got so many positive comments from all of this, from the institutional people like hedge fund managers out there and my work, and from people using it, that we launched it as a separate program, as many of you will know. I'm going to answer your questions now. Oh, thank you, Ravi. I've got an email from you as well today. Thank you so much. I'm going to broadcast that comment to the room. Does anything overruled? Yeah, well, the 20% ruled by me many times if I feel that actually historically this stock, it drops 30%, 35% on its way up. But think of it this way. If you turned it to a 90% rule, then it'd be pointless having it, wouldn't it? 80 would be pointless. 50 would be pretty shaky, wouldn't it? That's why. So there isn't an answer without a time machine on it. But I'd say, okay, more like the Magnificent Four. It is a bit, isn't there? Is a fund that just covers the Magnificent Seven? Probably are. Does anyone? Okay, thank you, Ravi. Aiden, any comment on JD.com? Wondering if it is overbought. No, I don't think it's overbought. JD.com is one which I'm thinking of buying probably tomorrow. So no, I don't think it's overbought. Where did you get that idea from? Pension is up 10% since I took control in March. Down to you and Alpha Picks. Thank you very much, Will. And the funny thing is, look, I wish, Will, the markets just went up like this. But I'm glad that when you do take control and you're looking at what you're doing and you fix your it your way, as in what suits you, it can help. And of course, with all of this, I give people unlimited access to me on top of it as well. What I do during this period, during the webinars, is also give a discount for people. My goal is, once I get a certain number on the program, and it used to be 250, but I think I might allow 300. For the first 300, it'll always be me as mentor for life, and there'll be no ongoing charges at all. It'll be one-off. In future, the idea is it'll go global. There'll be other teachers for other people. There'll be subscriptions for other people, but not for the first 250, 300-ish, because I can manage that, because I want to prove the concept and then get venture capital investment in, or I might self-fund and then eventually IPO, because I think it can be bigger than St. James's Place. Because unlike St. James's Place, I've got global clients for a start, and they've got 900,000 unhappy clients just waiting. Not all of them will want to do it themselves, but I think a hell of a lot of them will. And what most people want is they want the database. The question they always ask me is, how frequently is it updated? Every single month. And they want unlimited access to me for calls. Those are the two things they want. They're less bothered about what I own, though I share that as well. But I remind them that I might sell something, as I did with I almost purposely sold Microsoft because I wanted to shake them off, trying to think that they've got to copy everything I do. Because what they should be doing is saying what's appropriate for their risk appetite instead. Aidan must have, but sold up 47% to us, so thought I'd ask. Thanks, Clive. Aidan, just check that you're looking at the monthly prices on Yahoo on that one. You might be looking at weekly, and people often make that mistake. Are there May buys you can divulge? Kishan, probably the major May buy is probably going to be JD.com, I think. And I think I showed you Tyler. I've not bought that or Tyler. Yeah, I showed you Tyler earlier on as a special situation. They come to mind. Initially, and if others come up, I'll put it on Telegram. At the moment, I've been a little bit reticent about May because I wasn't sure how it's going to turn out, and now it looks a bit better than I thought it was going to look. If you've got a 100K portfolio and you do a 20% return, and you've got it for life anyway, that's 20K. If you've got a $500,000 portfolio and you do a 20% return, you made 100K. You've made your money back in 1 year, so it becomes a no-brainer. That's the idea. Okay, those are the links if you want to join the program. We're also adding in-person events 4 times a year, and clients will get invites to those, and dinners as well with great speakers on that as well. So hopefully I'll see you in person. STRL jumped 50% after earnings this week. Does anything? Oh, wait a minute. Is there a fund that just? Oh no, more like. Oh, okay. I've answered all of this. Right. I have kept it. Oh, I've gone over again. I was trying not to go over the hour. That was it. Was looking at weekly, not monthly. New Yahoo fans. Ta Aidan. See how good I'm really proud of myself. I worked out without even looking at the screen what you might be looking. Good. This is one of the reasons why I also give unlimited access to me. Sometimes people in the initial years, like driving a car, they make a slight error here and there, which is fine. Those things happen. Okay. And then we can correct it. And like learning to drive, I pointed out to somebody, I said, well, have you ever been in touch with your driving instructor since you passed? And they go, no, of course not. Well, there you go. Once you get competent, you don't need to keep contacting me. You're more than welcome to if you wish, but you don't have to by any means. In fact, now, because we do the physical event, I get to see the students a lot more often, although we have got students everywhere from the Bahamas to New Zealand to Australia and so on as well, which makes me really excited. Thank you. Bayern Real. I really want to watch it. What time is it starting? 8, 7:30, 8 or 7:30 or 8? Is it tonight? Must be for a place in the final. Yeah, obviously it's tonight. I said PSG, I know, and they went down. So you go short on whatever I say. I want to say Real because I think it'll be a great sort of a better final if it's Real Madrid and Dusseldorf and Dortmund. But if it's an all-German final at Wembley, my 2 business partners are German. You know, I mean, they are fun actually, I should say. But no, I think it's better when it's proper European. So yeah, sorry, I'm going to go with Real, which obviously means Bayern Munich are going to win, doesn't it? Of course it does. Right, so there we go. It's going to be one hell of a match, though. I wish I was in a pub somewhere watching it. I'm going to be home. Okay, so that's what we try to do with this. We try to close every single reason why somebody would say, okay, but what about this? What about this? What about this? Anyway, any other questions? And then I'm going to get jumping. Thank you all for watching. If you've got any other questions, do let me know. If you'd like me to reserve a place because you want to have a think, let me know as well. We are going to be putting prices up again, I'm afraid. And the reason for that is because we'll monitor the returns people are making, and it's a function of that. Once we get a whole load of people with larger amounts making more, that's the reason. And it just means that we can do more and more and provide more data and more help and more of everything to everyone. Okay, so if there's anyone, thank you, Barish. Thank you, Avon and Peter as well. Thank you, and hope you like the new format. I've mixed it up a bit. I've put different stocks in rather than the same old. And I think next week maybe I'll go back to the old format, and then the week after back to this. We'll play around with it. We'll just see. Okay, and I did less sort of the theoretical stuff, which I've done in the past. Well, not theoretical, but I'll just show you. So on the Telegram channel, you'll know I posted. Where is it? There was a whole bunch of stuff I posted like this. I'm not sure what you can see. Can you? Oh, that's the wrong window, I think. Nope. Ah, there we go. Like this and so on. this is why you want to, beat inflation and so on. So I did less of that this week. So if you like this format, let me know. If there's any changes you'd like, please let me know. It was a great idea. Good. I'll try and cover more stocks as well. That's a good one to show as well. It's fascinating. On there, what else can I show you? I don't know if I showed you this last week. UK equity valuations looking cheap and so on. What kind of returns could we expect when we're at this kind of PE ratio? We're at that green line. Well, it could be anything from, I don't know, 40% year to a minus 20%. That's the points where we want to be holding cash. Well, it doesn't look like this year is going to be like that, obviously. And we want to be in a position to get those 20% in the S&P, because if we get 20%, even if we match the S&P, great. Obviously, we'd be looking to get a tailwind by cherry picking and get more than that. Okay, everyone, thank you all very much indeed. I will leave it at that. Thank you for watching the webinar. Really appreciate it. Any other questions, just email me or put it in the chat box. We'll have a look as well. And enjoy everything that you're doing, whatever it is. Enjoy the sunshine as well. Thank you. Thanks very much, everyone.